Good morning. It's Tuesday, April 22nd. Thanks for joining me. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So we got turnaround Tuesday here on the markets with a lot of green on the screen. You got the S&P 500 futures are bouncing back up about 1% right now, trading up 50 points at 52.35. The low of the overnight session was 51.71 and 3/4, and yesterday's turbulent session here reached down to about 51.27 and 3/4. So yesterday's sell-off, remember, when you come off of this holiday week where markets are closed down and then you roll that into a Monday where European markets are also shut, you're going to have lighter volume. And yesterday, we didn't have any economic data coming out. There was not a lot of dialogue and discussion. A lot of people did position on the long side of the equity markets or exited gold futures into that Friday close. And the reason why they did that was because they believed that the possibility of additional trade discussions would take place here, and perhaps some agreements would be done with China and things like that. With no discussions being made and no agreements being made, we saw a lot of people liquidating out of the market in that thinly traded session here and then repositioning back into the gold market. So that was kind of the reason for yesterday's two-sided trading action, accelerated sell-off and then dip buyers into the close. We do see gold futures, they topped a new record on the futures contract on the June one at $3,509.90 in the overnight session here, and this comes after markets bouncing off of those lows at 34.23.90. So up about 1% right now, and investors are really weighing in on the trade progress and trade talks with India. We've seen a lot of dialogue coming in the overnight session between the US and India's commitment to buy certain defense weapons, certain commodities and things like that from the United States. So Tesla, they also have some upcoming earnings with questions surrounding the ability to meet annual sales goals, while other companies such as Halliburton, 3M, General Electric, they're all scheduled to report. We do have the dollar index here slightly firmer here, which is a change of pace from what we've seen after falling to a 15-month low, with Goldman Sachs predicting that additional weakness will continue, and we do have the treasury markets here strengthening just a bit. Something to note, with the dollar index selling off, we have also seen treasury yields rising back up, and that's been a bit of a disconnect from what we normally typically see. When you see strengthening dollar, you see strengthening yields, and this has been a bit of a mixed bag here. So the yield on the 10-year treasuries has been little change here, up about 4.41% and making a new high 4.42% right now as of this recording. So at the same time, you do have the yen reaching the highest level since September, with concerns over the US-China trade war and potential changes to the Federal Reserve. That story is gaining a lot of momentum, and the direct blows that Donald Trump took on Jerome Powell is a little bit concerning as far as I'm concerned. So I've always respected Jerome Powell. He hasn't done what I've always wanted him to do. Remember at the December meeting, they cut rates, everyone was anticipating it, and he said that they were on the fence with it, that it was a 50-50 shot. And what happened? Gold futures plummeted, U.S. equities plummeted, and the markets really got the rug pulled. So he has disappointed me several times here with some of his dialogue, especially in the post-press conference. But I understand what he's doing. There is a lot of certainty, and there is a lot of volatility in these markets, and that's why they are in this holding wait-and-see pattern. If you look at year-to-date performance, the best performing futures out there is the volatility index, up 89%. When you have volatility that high, it's tough for the Federal Reserve to really make any kind of concrete decision, because trade talks could evolve between the US and China, and from that point forward, we could see a steady rise in the markets, and we could see kind of some leveling off in this volatility. We could see some of these key commodity exports take place, and we could see more normalization take place in the markets, and then the Federal Reserve can come forward and start to cut rates as things level off. So you look at cryptocurrencies, you do have Bitcoin rising about 1.2% overnight at 88,403. You also have Ether up 3.1%. And checking in on the gold market here, again, 3509.90 being the high in the overnight session, trading at 34.68 last, up about $42. You do have silver futures having a little bit of a wild ride in the overnight session, about 60 cents back and forth. We're up about 15 right now. Since I was putting some of the notes together for this video, video, it has been about down 15 cents to up 15 cents. So expect that volatility to kind of continue with the flows of the gold market. But obviously with the gold silver ratio at 106 to 1, is silver really tracking gold? In my opinion right now, no, it's not. There's been a lot of arguments about valuation plays and things like that, that silver is dramatically undervalued in comparison to gold, but really it's the industrial demand, it's the other outside metals, it's other news flows that are impacting that market. Remember, one major component of silver and silver demand is solar, and there's been discussion about tariffs and things like that on the solar industry, and I think that the US ratcheted up some solar tariffs to like 3,500% because of the fact that solar produced in other countries like Vietnam and Malaysia and things like that are being, because of the subsidies that they get from the government to produce these things, they've been selling it below cost and dumping it throughout the globe here, and that has dampened some of the silver demand out there. Now looking at gold and back to it, the Chinese markets continue to add open interest on the Shanghai Futures Exchange, and they've hit multi-year highs. So you look at open interest on gold, well, that is at multi-year highs in China. So China is really actively pursuing the gold market right now and has been the main driver, and it's also reflected in, look at yesterday's trading session, look at previous trading sessions. We've had 3 $100 plus moves in the gold market, and when has most of that happened? And I discussed that. It's the when also as to the why and the how are we making these moves, because when this market is making its move is the overnight session, which tells you that it's just active foreign buyers really stepping into that market. Now the question remains, how high is too high on the gold market? So you look at a UBS note that they just released, and they said that gold has continued to serve an effective hedge amid this ongoing trade uncertainty, taking its gains since the start of the year close to 29%. So it's the second best performing future, up about 29% right now as at the time of the writing. Now, despite the strong performance, they said they continue to see upside potential, and they target with a base case of $3,500 an ounce for year end versus $3,411 at the time of the writing. Well, where's the market? Where did it get to last night? It already reached their year-end price target here. So they say they continue to see support from investment demand, ongoing central bank diversification, and a volatile macro backdrop. What happens if this prices start to get too high? You don't see that investment demand come in. That's where we are monitoring ETF flows, we're monitoring CTA positioning, and we're also looking at money manager positioning as well to see how they're playing out. Are they stepping into the market? Are they coming out of the market? Central bank demand, will want to watch that as well, because of the fact that if treasury yields get too high, perhaps some confidence in the US treasuries takes place, and we start to see that flow go into the market and less into the gold market. Remember, you always want to kind of play devil's advocate when you're watching some of these markets. You got to have your checks and your balances in play in order to trade the commodities and the volatile macro backdrop. Well, what if we get some stabilization in US equities and things like that? Now, Goldman Sachs, they put out a note, and this was just a couple of days ago, saying that gold is at an attractive entry point. Now, that was a few $100s lower, and they released a new note this morning saying gold, is it still attractive at these price levels? And they're saying that it's already reached $3,500 already, and that you look at Shanghai mining and Chinese mining shares are up 30% over the last month. So what they break down and they kind of look at is that money managers have generally taken profits and managed their overall exposure as prices have continued to push higher. So if you look even inside, the way that I work with clients individually was, earlier into last year and in fall of last year, we were adding to gold positions, gold futures, 10-ounce contracts, 1-ounce contracts, hundreds, 50-ounce contracts. And then you start to get these record highs where you get explosive $100 moves. Well, it's natural that you're going to want to take some of that exposure off. And as prices continue to go higher and you trim and trim and trim, well, what are you left with? There's nothing left on your plate. So even looking at myself in the way that I've been exposed into the gold market with clients and looking at their positioning, they are coming off to much substantially lower levels, and even many clients are coming in and starting to put shorts on in the golden market, thinking, hey, this might be a great opportunity to hedge some of the gold and gold holdings that I have that I don't necessarily want to part ways with physically, that I'd like to put a hedge into place, just like the same thing like a farmer would hedge his agricultural product. So what they look at is the correlation here during the last last 2 years preceding the last 6 months, and the correlation here between money manager contract net length and the gold price is plus 0.93%. Basically, it says that as gold prices go up, money managers have been adding. But what had happened is the money managers trim their positions going up into these record highs and these explosive moves higher. And now you start to look at the last 6-month correlation, and it's actually negative 0.43. So gold prices are going up, and they're actually just completely coming out of that gold market here, or perhaps putting even on downside outright hedges looking to potentially buy the dip. So you look at money manager gold contract net length is currently at a 1-year low here, and at the 60 to 70% historical rank on a minimum max normalized total market size and an adjusted dollar. So it sounds really complicated, but the reality is that this note just says that a lot of the money managers have come significantly out of the market. Now we want to look at the flip side of that, and the ETF flows, because that's been something else that we've been monitoring here in exchange traded funds. Well, they added 50,000 ounces of gold here in their holdings in the last trading session, bringing this year's net total purchases to 6.62 million ounces. So the ETF holdings, they are at the highest level since September 2023. The year-to-date performance, again on gold, up 30%, VIX up 83%, silver up 10%. The year-to-date percentage change on the ETF holdings on gold is 8%. That's the largest year-to-date percentage change we tracked all year. You got silver plus 2.4%, but look at the gold and silver ratio, 106.5 to 1. So that's just kind of unpacking some of the things on the gold market here. My suggestion is not to look at chasing these prices higher, because of the fact if you do get a bit of a rebound in the dollar index, you do get some stabilization in this Jerome Powell, this Donald Trump spat that's going back and forth here, and the Fed doesn't cut rates, we see things start to normalize a bit, then we'll start to see some of these outflows come, and I believe we'll see attractive entry points here on the gold market. In the chart pack, I do outline some of the recent levels that were resistance points that now become support levels, and those could be different ideas here as far as entries. Now, as far as resistance is concerned, I post that in the Metals Edge, and it takes in the volatility that has taken place over the past several days here, and it'll give you an idea as far as where some upside levels could be. And as we get $300 moves, well, those $100 moves tack on to the volatility and the potential for it. So your first resistance point on the gold market is just over that $3,500 level, then about $3,550, and then $3,616. Your first level supports way down at $3,407, and then $3,379 and $3,351. And believe it or not, with the way that the markets are playing out, all those different levels could be achieved here within a short period of time. So we're going to really want to keep an eye on this, keep an eye on volatility. And that's where I said money management, really having to find your risk, really not getting involved with the market where you just blindly go into something without some kind of plan. You always want to plan your trade your plan, and that's the key here to getting into these markets. And remember, some people say cash is trash, but cash sometimes is peace of mind here at the moment, where you could sit there and look at where your entry would play out. There's a lot of markets like crude oil futures snapping back up about 1% after yesterday's steep decline. You got soybean futures here rising up after strong demand for U.S. crops, a weaker dollar. It makes those exports for some of those commodities really competitive here, and it kind of softens the blow with the trade war with China. So you look at soybean shipments for exports, they were up 24% from a year earlier at the end of the week of April 17th. So there's just a lot of commodities out there that could give you other entries and things like that. But remember, figure out what your goal is, figure out what your risk parameter is, figure out how you want to play this market out, plan your trade your plan. So you guys got any questions, reach out. Remember, shoot an email, info@Blue Line Futures, anything you need here. Be sure to register. So some of the data, some of the different research reports we're putting out here, and let us know if there's any reports that you'd like to see on as far as other outside commodities, whether it's a crypto report, whether it's a treasury report, things like that. We're always open to suggestions here, as we are a big growing firm here, and we've got a lot of manpower to provide some of these resources to the clients and to the public here. So remember, futures and option trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck and good trading.